In 2013, a research team at the University of California spent 2 years tracking the daily habits, financial decisions, and personal histories of self-made millionaires. People who built their wealth from scratch, without inheritance, without windfalls, without a family name that opened doors. The findings were uncomfortable, not because they revealed something impossible, but because they revealed something most people already have access to and never use. 50 individuals. Different industries, different countries, different starting points. And yet, when the researchers mapped their behavior across 2 decades, certain patterns emerged with a consistency that was hard to ignore. Not personality traits, not luck, not talent. Patterns of decision-making that repeated themselves regardless of the field, the era, or the bank balance they started with. The question this video is going to answer is a simple one. What do these people actually have in common? And why does almost nobody talk about what it really is? The first thing most people get wrong about self-made millionaires is the story they tell themselves about how it happened. Ask a random sample of Americans what separates someone who builds a 7-figure net worth from someone who does not, and the answers tend to cluster around a few recurring themes. Exceptional talent in a specific field, relentless and borderline obsessive work ethic, a willingness to take risks that ordinary people consider reckless, or simply the kind of fortunate timing that no amount of planning can replicate. These explanations are psychologically convenient because they do something useful for the person offering them. They place the outcome outside the reach of most people. If wealth is primarily the result of rare talent or lucky timing, then the gap between the millionaire and everyone else is structural. It is built into the system, not into the behavior. And if it is built into the system, there is very little to be done about it except resent the gap or wait for circumstances to change. This framing has a long history of institutional reinforcement in business schools, in financial media, and in the wealth management industry itself, which benefits considerably from the belief that ordinary people cannot reliably build capital without professional guidance. The more inaccessible wealth appears to be, the more products exist to sell access to it. The data does not support that framing, not in any meaningful direction. The UC study mentioned at the opening of this video is not an outlier. It sits inside a body of research that has been accumulating for the better part of 4 decades, and the consistent finding across that literature is that the popular explanation for self-made wealth is wrong in almost every direction it points. A longitudinal study published in the Journal of Wealth Management followed 233 first-generation millionaires over 18 years, tracking not just their financial outcomes, but the specific decisions they made in the years before those outcomes materialized. The results contradicted the popular narrative almost entirely. Only 11% of participants described luck as a primary factor in their wealth accumulation. Only 14% identified formal education, the degree, the institution, the credentials, as a decisive advantage. And fewer than 1 in 5 credited a specific professional skill, whether in technology, finance, or engineering, as the central driver of their net worth. What the remaining majority described, across industries and income levels and starting points, was something considerably less cinematic than the stories that typically get told about wealthy people. Not a product that disrupted a market, not a single investment that multiplied 30 times over, not a mentor who handed them a blueprint and told them exactly what to do next. A set of behaviors that repeated themselves year after year and compounded in ways that only became visible long after the decisions themselves had already become routine. The word that deserves attention there is compounded, because it is doing more work than it appears to. When most people encounter compounding in a financial context, they reach for the interest rate example. Invest early, earn returns, let time do the math. That is accurate as far as it goes. But it misses the deeper point that the research keeps arriving at. What the data consistently suggests is that compounding is not only a mathematical phenomenon, it is a behavioral one. The decisions these 50 individuals made did not produce dramatic short-term results. In most cases, they produced nothing visible at all for years. What they produced, slowly and without any fanfare, was a structural gap between where they were headed and where the people around them were headed. One that widened with every year they kept making the same choices. The question is what those choices actually were. And the answer begins in a place that most people find deeply unglamorous, which is precisely why most people never stay there long enough for it to matter. The unglamorous place the research keeps returning to is the relationship these individuals had with spending, not in the moralistic sense that personal finance content tends to favor, where the lesson is always some variation of spend less, save more, delivered with the enthusiasm of someone who has never had to choose between a car repair and a rent payment. The pattern the data reveals is more structural than that, and considerably more interesting. What the 50 individuals in the UC study shared was not frugality as a personality trait. Several of them spent freely, on travel, on experiences, on things they valued. What they did not do, with a consistency that held across the entire sample, was spend reactively. The distinction matters more than it might initially appear to. Reactive spending is the dominant financial behavior in the United States. It is the default. When income rises, consumption rises with it, often faster. When a new product becomes culturally visible, the purchase follows shortly after, driven not by a considered assessment of value, but by a combination of social signaling and the ambient pressure of living inside a consumer economy that is engineered, with considerable sophistication, to eliminate the gap between desire and transaction. The average American household spends 97 cents of every dollar it earns. That figure has remained remarkably stable for decades, across income levels, across economic cycles, across administrations of every political stripe. It is not a poverty statistic. It describes behavior at the median, in households earning well above subsistence level. It describes people who are, by most measures, doing reasonably well, spending almost everything they make, and accumulating almost nothing in the process. The millionaires in the UC study did not spend 97 cents of every dollar. Across the sample, the average savings rate in the decade before they crossed the seven-figure threshold was 28%. Not because they were earning extraordinary amounts. Many of them were not, at least not initially, but because they had made a structural decision, early and deliberately, to treat saving not as what was left after spending, but as the first claim on every dollar that came in. This is not a new idea. It appears in financial literature going back at least a century, and it has been restated so many times in so many formats that it has acquired the dull patina of received wisdom, the kind of advice that everyone has heard and almost nobody has operationalized in any serious way. What the research adds to the familiar formulation is specificity. It was not simply that these individuals saved more, it was that they saved automatically, structurally, before the money was ever available to spend. The behavioral mechanism behind that distinction is well documented in the literature on financial decision-making. When saving is a deliberate act, something you do after reviewing what is left, it competes directly with every other claim on your attention and your resources in that moment. When it is automatic, when the transfer happens before the balance is visible, it disappears from the decision entirely. The money that does not appear in your checking account is not money you consciously choose not to spend. It is money that never entered the spending calculation at all. That mechanism, repeated across years and decades, is where the first structural gap begins to open. But it is only the beginning of the pattern, because what these individuals did with the money they did not spend turns out to be at least as important as the act of not spending it. What they did with the money they did not spend follows a pattern that is, on the surface, almost aggressively unexciting, which is itself part of the explanation for why it works as reliably as it does. The investment behavior of the UC study's 50 participants did not resemble the portfolio of someone trying to get rich. It resembled the portfolio of someone trying to stay rich while gradually becoming richer, a distinction that sounds semantic until you examine what it produces over a 20-year horizon. Across the sample, the dominant asset class was not individual stocks, not cryptocurrency, not real estate speculation, and not the kind of concentrated bet in a single company that produces the dramatic wealth narratives that populate business journalism. The dominant asset class was diversified, low-cost index funds, a vehicle so structurally boring that it rarely generates a headline, and so consistently effective that it has outperformed the majority of actively managed funds in every decade since Jack Bogle introduced the first commercially available index fund to retail investors in 1976. The average annual return of the S&P 500 over the past 50 years, including every recession, every market crash, every geopolitical disruption, and every moment when the consensus view was that this time the recovery was not coming, has been approximately 10.5% before inflation. A household that invested $500 per month beginning in 1990 and never adjusted that amount, never tried to time the market, never moved the allocation in response to headlines, arrived at 2020 with approximately $1.1 million, without a single dramatic decision, without a single exceptional year, without doing anything that required specialized knowledge or unusual courage. The 50 individuals in the study did not all use index funds exclusively, but what they shared was the underlying behavioral logic that index fund investing makes structurally unavoidable. They did not try to beat the market, and they did not exit the market when it declined. Those two behaviors, the attempt to outperform through active selection and the impulse to sell during downturns, are among the most thoroughly documented destroyers of retail investor returns in the academic literature. A 2020 analysis by Dalbar, which has tracked investor behavior against market returns for 3 decades, found that the average equity fund investor earned 2.9% annually over the preceding 20 years, against a market return of 6.1% over the same period. The gap is not explained by fees alone. It is explained primarily by behavior, by the tendency to buy after markets have risen and sell after they have fallen, which is the precise inverse of what the math requires. The millionaires in the study did not do this, not because they were immune to the psychological pressure that drives that behavior. Several of them described, in the qualitative portion of the research, the visceral discomfort of watching a portfolio decline by 30 or 40% during a contraction and choosing not to act. The operative word there is choosing, because the absence of action during a market decline is not passivity. It is a decision made against considerable psychological resistance, and it is one of the few financial decisions where the correct answer is almost always the one that feels the most wrong in the moment it needs to be made. That behavioral consistency, buying regularly, holding through contractions, ignoring the noise, is the second structural pattern the data keeps surfacing. But there is a third one, and it is the one that tends to surprise people most when they encounter it in the research. The third pattern is the one the popular narrative about wealth building gets most consistently wrong, not by ignoring it entirely, but by describing it in a way that misses the structural logic underneath it. The surface version of the finding sounds familiar. Self-made millionaires tend to have more than one source of income. That observation has circulated widely enough in personal finance content that it has become something close to a cliché. The advice to build multiple income streams delivered alongside a list of side hustles, freelance platforms, and passive income strategies that typically generate more content about earning money than actual money. The research finding is not about side hustles. What the data from the UC study revealed, and what a parallel IRS analysis of tax returns from households that cross the $1 million net worth threshold confirmed, is something more structural and considerably more deliberate than the popular framing suggests. The IRS analysis, which examined a decade of returns from first-generation millionaire households, found that by the time these individuals crossed the 7-figure threshold, an average of 65% of their income was coming from sources that did not require them to exchange time for money in any direct sense. Dividends, rental income, business equity distributions, royalties, and investment returns. The remaining 35% came from active work. That ratio had not always looked that way. In the early years of their wealth-building period, the overwhelming majority of their income was active. They were working, earning, and directing a portion of that earned income into assets that would eventually generate returns of their own. The shift happened gradually, almost imperceptibly, as the asset base grew large enough to produce meaningful passive distributions. But, and this is the part the popular version of the story tends to omit, the shift was not accidental. It was the intended outcome of a deliberate allocation strategy that these individuals had been executing for years before the results became visible. They were not building multiple income streams in the entrepreneurial hustle sense. They were systematically converting active income into income-producing assets, with the explicit long-term goal of reducing their dependence on any single point of income failure. The behavioral logic behind that strategy is more risk management than wealth maximization, and that distinction reveals something important about how these individuals actually thought about money, which turns out to be fundamentally different from the way most people think about it. The majority of working households in the United States are 1 or 2 missed paychecks away from a liquidity crisis, not because they earn too little necessarily, but because their entire financial architecture rests on a single income source that can be interrupted by a layoff, an illness, an economic contraction, or a decision made by someone else in a boardroom they will never enter. The millionaires in the study had, over time, engineered their way out of that structural vulnerability. Not in a single move, not through a dramatic entrepreneurial bet, but through the patient and methodical conversion of earned income into assets that continued generating returns, regardless of what happened to their primary employment. That process, slow, unglamorous, and almost entirely invisible from the outside until it reaches a certain scale, connects directly to the fourth pattern the research surfaces, which is perhaps the most counterintuitive finding in the entire dataset. The most counterintuitive finding in the dataset is not about money at all, at least not directly. It is about time, and specifically about how these 50 individuals allocated their attention in the years when their wealth was still being built rather than enjoyed. The popular image of the self-made millionaire is someone who works more than everyone else. The 70-hour week, the relentless grind, the willingness to sacrifice sleep and relationships and leisure in pursuit of a financial outcome that is always just one more quarter away. That image is not entirely fabricated. Several of the individuals in the UC study did go through periods of intensive work, particularly in the early stages of building a business or establishing themselves in a field. But the longitudinal data tells a more complicated story than the hustle narrative allows for. When the researchers tracked the actual time allocation of participants across the study period, not what they reported in interviews, but what their calendars, communication records, and self-reported logs reflected, they found something that contradicts the dominant cultural story about how wealth gets built. The individuals who accumulated the most, over the longest periods, were not the ones who worked the most hours. They were the ones who were most deliberate about what they worked on. The distinction between working hard and working deliberately sounds like the kind of motivational reframing that belongs on a poster rather than in a peer-reviewed study. But the data behind it is specific enough to resist that dismissal. What the high accumulation group spent disproportionate time on, relative to the rest of the sample, was a category the researchers labeled high-leverage activity, defined as work whose output continued generating value after the work itself had stopped. Writing a process that someone else could execute, building a client relationship that would produce referrals for years, designing a system that removed a recurring decision from their daily attention, creating an asset, whether intellectual, relational, or financial, that would keep working after they stopped working on it. What the lower accumulation group spent disproportionate time on was execution, the direct, hands-on delivery of whatever product or service their income depended on. They were, in most cases, extremely good at that execution. They were productive by any conventional measure, but their output was linear. More hours produced more results, and fewer hours produced fewer results, in a relationship that never broke free of the direct exchange of time for value. The researchers estimated, based on the time allocation data, that the high accumulation group spent an average of 23% of their working hours on high-leverage activity during the peak wealth-building decade. That is not a majority of their time. It is roughly 1 day per week, but compounded across a decade, that 1 day per week of deliberate, leverage-oriented work produced an asymmetric return relative to the remaining 4 days of conventional productive effort. A 2019 study from the Harvard Business School reinforced this finding from a different angle, examining how senior executives at Fortune 500 companies allocated their calendars. The researchers found that leaders who dedicated at least 20% of their time to what the study called future value creation, strategy, relationship building, system design, produced measurably better long-term outcomes for their organizations than those who spent the equivalent time on operational execution, even when the operational execution was high quality. The mechanism is not mysterious. High-leverage work builds infrastructure, systems, relationships, assets, capabilities that generate returns independent of the hours invested to create them. Conventional execution, however skilled, does not. It produces value once and then requires the same investment again to produce value again. The gap between those two modes of working is the gap between a career that plateaus and one that compounds, and it connects directly to the final pattern in the data set, the one that explains not just how these individuals built wealth, but why they kept it. The final pattern in the dataset is the one that explains why the wealth these individuals built did not disappear, which is a more important question than it might initially appear, given that the research on wealth retention tells a story that is considerably less flattering than the story about wealth creation. A 2014 study by the Williams Group, a wealth consultancy that has worked with high-net-worth families for decades, found that 70% of wealthy families lose their wealth by the second generation, and 90% lose it by the third. That figure is not primarily explained by estate taxes, by market downturns, or by the structural disadvantages that inherited wealth occasionally creates in the people who receive it. It is explained, according to the researchers, by a failure to transmit the behavioral infrastructure that produced the wealth in the first place. The decision-making patterns, the relationship with risk, the capacity to delay gratification across time horizons that extend well beyond the next quarter. The 50 individuals in the UC study had, with few exceptions, maintained and grown their wealth across time periods that included at least 2 major market contractions, significant personal disruptions, and economic environments that were hostile in ways that their earlier wealth-building years had not prepared them for. What allowed them to do that was not a superior investment strategy. It was not a financial advisor with better models. It was a behavioral characteristic that the researchers, after considerable deliberation about terminology, chose to call financial identity, a term that deserves more unpacking than it typically receives in the popular literature on wealth. Financial identity, as the researchers defined it, is the degree to which an individual's core sense of self is aligned with a specific set of financial behaviors. Not financial outcomes, not net worth, not the visible markers of economic status, but the behaviors themselves. Saving automatically, investing consistently, allocating time to high-leverage work, managing income sources deliberately. For individuals with strong financial identity, these behaviors are not acts of discipline in the conventional sense. They do not require willpower in the way that a diet requires willpower, where the default pulls in one direction and the behavior requires constant effort to maintain against that pull. They are simply what the person does, in the same unremarkable way that most people brush their teeth in the morning without requiring motivational intervention. The researchers identified this characteristic through a combination of psychological profiling and longitudinal behavioral tracking, and the correlation between financial identity strength and wealth retention was among the strongest findings in the entire study. Individuals in the top quartile of financial identity scores had retained and grown their wealth across the full study period at a rate more than 4 times higher than those in the bottom quartile, controlling for income level, industry, and starting net worth. The practical implication of that finding is uncomfortable in a specific way. It suggests that the primary obstacle to building and keeping wealth is not informational. The information required: spend less than you earn, invest the difference consistently, build assets that generate passive income, allocate time to leverage rather than execution, is not proprietary. It has been available in various forms for decades. What is scarce is not the knowledge, but the degree to which that knowledge has been internalized deeply enough to reshape behavior at the level of identity rather than intention. The gap between knowing what to do and actually doing it consistently, across decades, under conditions of stress and uncertainty and competing demands, that gap is where most wealth-building attempts fail. Not at the level of strategy, at the level of identity. And that distinction reframes the question the UC study was originally designed to answer. The question was, what 50 self-made millionaires had in common? The answer the data kept pointing toward was not a tactic, not a vehicle, not an industry, and not a moment of exceptional insight. It was something considerably more foundational and considerably more available than any of those things. But to understand what it actually means in practice, it is worth looking at what the researchers found when they examined the specific moment in each participant's history when the trajectory changed, the inflection point where the pattern that would eventually produce the outcome first became visible. Because in almost every case, that moment looked nothing like what most people expect wealth building to look like. And in almost every case, it happened years, sometimes decades, before there was anything in the financial statements to suggest that something significant had begun. The inflection point, when the researchers mapped it across the 50 participants, looked almost identical in every case, and almost nothing like the founding myth of self-made wealth that business journalism tends to produce. It was not the launch of a company. It was not a promotion, a windfall, or a market bet that paid off at the right moment. In the overwhelming majority of cases, the inflection point was a decision, quiet, private, and entirely invisible from the outside, to stop treating financial behavior as a response to circumstances and start treating it as a commitment that existed independent of circumstances. The researchers described this as the moment when financial behavior shifted from conditional to unconditional. Before the inflection point, the typical pattern looked like this: saving when there was something left over, investing when the market seemed favorable, building assets when the primary income felt stable enough to permit it. All of those behaviors are rational responses to uncertainty. They are also, the data suggests, almost perfectly designed to prevent the compounding that wealth building requires, because they make the foundational behaviors contingent on conditions that are never reliably present at the same time. After the inflection point, the pattern changed in a specific way. The behaviors became fixed. The savings rate did not fluctuate with the monthly balance. The investment contributions did not pause during contractions. The time allocated to high-leverage work did not compress when operational pressures increased. Not because these individuals had eliminated uncertainty from their lives, they had not, but because they had made a prior decision that the behaviors were not negotiable regardless of what the circumstances suggested. That shift, from conditional to unconditional financial behavior, is the common thread the research found running through all 50 cases. It is not a strategy in the conventional sense. It does not require a specific income level, a specific industry, or a specific moment of market opportunity. It requires a decision about what kind of person you are going to be with money, made before the conditions for that decision feel comfortable, and maintained after the conditions for abandoning it feel entirely reasonable. The UC study framed it this way in its conclusion: the individuals who built and sustained significant wealth were not those who responded most intelligently to financial opportunity. They were those who behaved most consistently in the absence of it. That sentence is worth sitting with, because it reframes the entire question of what wealth building actually demands. It is not primarily a question of information, of access, of timing, or of talent. It is a question of behavioral consistency across time. And behavioral consistency is, in the end, a function of identity rather than discipline. You cannot willpower your way to a 20-year savings rate. You can build a self-conception in which that savings rate is simply part of who you are. The 50 individuals in this study did not all start with money. They did not all have degrees from prestigious institutions, mentors with the right connections, or industries that rewarded them disproportionately for their early efforts. What they had, in every case, was a prior decision, made quietly, without fanfare, and long before there was any financial evidence that it would matter, to behave like someone who builds wealth, before they had any particular reason to believe that they were. That is what they all had in common, and it is available to anyone willing to make the same decision. If you have made it this far with me, I want to invite you to subscribe to our channel and follow along every day. If this video gave you something worth thinking about, share it with 5 people you think would find it useful. A conversation about this tends to be more valuable than watching it alone. Leave a comment with what you took from it, or with the question you wish this video had answered, because that is exactly how we decide what to make next.